Not all variable rates are created equal. Choosing between one versus the other could be the difference between crying in your sleep or not having any issues relaxing in the evening. Particularly as it relates to the last couple of years, there are a lot of folks who regretted their decision to go variable, but that's not always the case. So before you run away and say variable rates suck and I want nothing to do with them because I had one during the last few years, stop. Watch this video. I'll break down to you exactly what you need to know to be able to take a variable rate mortgage today and if it even is the right decision for you. All right, let's just start off with the basics. What the heck is a variable rate mortgage? Variable rate mortgage at its base is a mortgage rate that can fluctuate based on market conditions from the Bank of Canada specifically. See how it works exactly is the Bank of Canada sets what's called an overnight rate, and then your bank will set what they call their prime rate. And most banks are the same. From there, normally you get a discount off of prime, which ends up being your total interest rate. But as the Bank of Canada increases or decreases rates, well, guess what? Your rate goes up or down with it. All right. Now that we got this out of the way, let's talk about other items. As of most recently, interest rates have been on the downswing, but with trends continuing to change month over month or year over year because of political moves and a variety of other things in the marketplace, it's important to keep in mind that the Bank of Canada can change directions like the wind, but they don't typically do it all the time. You see, the BOC, Bank of Canada, meets 8 times per year on scheduled announcements, and this is most commonly the time that they actually make announcements. And if they're gonna make an adjustment to the overnight rate, up or down, this is when it'll happen. So what has the Bank of Canada been doing lately over the last couple of years? As you'll notice in this graph right here, typically the Bank of Canada, just like any rate, goes in ups and downs. And if we look back all the way from 1997 to today, what you'll notice is that overall, up until recently, the Bank of Canada had been on a downward trend. But typically speaking, the Bank of Canada goes through about 18 to 24-month cycles, which means from the moment the rates hit their peak to the moment they decline, it's usually like 18 to 24 months. So if you look back historically, from March 1998, when it hit the peak, we saw it start to come down in December of 2000. Then we went ahead and we saw the next increase of June 2006, which we started to see the decrease in September of 2007. Furthermore, we saw the Bank of Canada hit a rock bottom, which was in 2009, and that was after the quote unquote, the US crisis. And of course, their bank recovered for a period of time in the mid-teens. It wasn't until about 2017, 2018 that we saw the Bank of Canada increase interest rates and then continue to decrease them after the COVID crisis occurred of 2020, following the most recent rate change, which put us at about July of 2023 for the height of the marketplace. And here we are today at the beginning of 2025, looking at the rates start to decrease. So as you can see, the rate cycles are typically about 18 to 24 months on average, and this continues to happen over and over again. Yet the reality is most people are more afraid of the BOC increasing rates than decreasing rates. Let's get back into variable rates. Let's talk about the types of different variable rates. This is a part that people get really mixed up, and there's 2 different types. You can call it what you want, but I'll tell you exactly what we call them. The first one is called adjustable rate mortgage. Now, adjustable rate mortgages reach their peak excitement whenever rates are going down. Everybody wants an adjustable rate because as the market goes down, as the Bank of Canada lowers interest rates, well, guess what? The amount of interest that you pay on your mortgage goes down, which means your monthly payment shrinks, which gives you more cash back in your pocket to be able to make decisions with your own money. Now, these are not the most popular when rates are going up, and often people are stressed out because their payments are going up unless there's someone that was savvy and they tested their income to make sure they could qualify for increased monthly payments. But even in most recent times, people didn't love the experience of being squeezed. Now, the second type is what's called a static payment or a frozen payment variable rate. This is more common at the big banks. There's only one large bank that actually offers the adjustable rate option, with the static payment option having its pros and cons. The cons with this option are going to be that as rates go up, of course, although your payment stays the same, you're paying less and less and less and less to principal till a point where you hit this trigger. And at the trigger point, you're not only paying a lot of interest, you're paying all interest and more, which means you technically start to go into reverse amortization territory, which basically means you're gonna have a mortgage forever, which scares the crap out of people. Ultimately, trying to figure out the best option for you, honestly, usually comes down to budgeting. Are you the type of person that you would want to meet the goal of having your mortgage paid down faster? You typically want to go with an adjustable. If you like the idea of payments going down, but you're okay with it going up if it had to, adjustable is better. If you want no fluctuations, but you want the benefit of the variable rate, then you're probably going to go with a static payment variable rate. As a last bonus consideration as it relates to that, static payment variable rates typically have monthly compounding in most situations, whereas adjustable rates quite frequently have semi-annual compounding. So it's important to know which one that is, because even if rates are equal when you get the mortgage, you will pay more interest in a monthly compounding rate than you will if it is a semi-annual compounding rate. Okay, so here's some key things that you wanna look out for when you're trying to decide about variable rates besides what is the rate that you're actually getting. So you know that you've got these discounts available on prime. You wanna start off with some of the basic things when it comes to a variable rate, just like any other rate mortgage. What are the prepayment options? Are they flexible? Can you prepay when you want to? Now, prepayment really quickly is when you're paying extra money down to your mortgage. A lot of people don't realize that when you do this, when you make a lump sum payment, all that money actually goes towards a principal and it pays down the mortgage faster than it might otherwise. So the first thing you wanna look for is typically what are those prepayment options? Some banks are much more open where they'll allow you to do it on any payment and they could do up to 20%, whereas other banks are much less open about this option. They could do as little as 10% of the balance of the loan. And they might only let you do that once per year on the anniversary date, which is pretty restrictive. And in the end, if you wanted to do it 6 months earlier, you would have paid more interest because of the fact that you accumulate that interest for the next 6 months on your mortgage. So that's the first thing you want to look out for. Now, the second thing you want to look out for is typically something that most people consider to be a feature of a variable rate mortgage, but a lot of people don't actually realize that it's not a guarantee. And that's actually the penalty for breaking the mortgage. So here's the thing, crazy to say this, but you might not actually make it through your 5-year variable rate mortgage term. You might only make it to year 2, 3, 4, or 5. Maybe you get divorced, maybe you have to sell your property, maybe you wanna break your mortgage to get access to equity, maybe there's better rates available in the marketplace. There's a million things that can happen, but if you wanna pay out that mortgage, it's important to note that it's not always 3 months worth of interest that you're paying. And if it is 3 months of interest that you're paying, there's a difference. You see, some banks will charge you 3 months of interest based on prime. If prime was 5%, that's different than what other banks will do, which is they'll do it after the discount. So if you have prime minus 1%, you're at a 4% rate today, then a 4% rate is a much lower. That can mean the difference of thousands of dollars in prepayment penalties when it comes to breaking your mortgage. And the other thing to look out for is some variable rate mortgages, even if they are variable rates, they come with restrictions. I call them restricted products or low frills products, where you have to pay a prepayment penalty of a minimum of X. X is usually 3.5% or 4% of the balance of the mortgage. So it's really important to note that if one of the reasons you're looking for a variable is flexibility, then you should probably look out to make sure what those penalties are. All right, the last thing is a discount on prime. The first part about that, what's prime? Not all banks have the same prime rate. Now, although most banks offer the same prime interest rate, there is actually a major bank in Canada that does not have the same prime rate when you compare it to the other banks. And any bank can technically change its prime rate if it wanted to be different, although not all of them do. So when you think about the discount on prime, are you comparing apples to apples, oranges to oranges, or are you comparing the two different things? Because again, just like one bank might have a discount of prime minus 1%, the other one might be prime minus 0.85, but the rates themselves could actually work out to being the same. And if that prime minus 0.85 bank actually had a semi-annual compounding and better prepayment terms, and this other one at prime minus 1 ended up having a monthly compounding and crappier prepayment terms, it could cost you more money. And in the end, it's important to try and figure out the distinction between those two options if you're looking out for a variable rate mortgage. All right, so here's the part that everybody really wants to know. Not only should I take a variable rate today, which is a good question, because we can look back in history and say, okay, over the last 25 years, typically speaking, when you compared fixed and variable, the variable had won up until 2023 at least. But we could look at that and say, okay, if you were to take a variable rate this year going forward, will that make more sense for you financially? And here's the thing. There's no way to actually guarantee this. If I were to pull up an amortization simulator, and if you look below in the comments, I put a link to the video where I actually used an amortization simulator to look ahead and see what it would look like if you took a variable rate. So even if you did that, there's so many things that can happen politically and in the marketplace, financially speaking, that could change those numbers. Now, again, a variable rate could save you money for a variety of reasons. Well, again, history suggests it will. History suggests that over time, it gives you the ability to have a lower interest rate, which means lower interest cost. It also means that typically, as I mentioned before, instead of paying a big fat interest rate differential penalty, you're paying 3 months of interest if you take the right product. But it could also mean a lot of stress if you're not prepared for the changes in the marketplace. So you really need to evaluate, are you someone that's comfortable with any fluctuations in your market? And are you opportunistic, or are you risk averse and someone who's a lot more conservative? If you're on the conservative side and you don't like any fluctuations on your budget, then depending on the marketplace, it may not make sense to go variable. Now, the reality is if you go fixed, there is a good chance or a chance, depending on where in the market you buy, that you'll end up paying more over time. But you might be okay with that cost certainty, knowing that you wouldn't potentially pay more in interest if variable rates went up. Now, outside of that, how are you making this decision? Well, the first one is figuring out what kind of variable rates you're gonna take. Are you gonna take the fixed payment and then just look for the benefit of prime going down? Or are you gonna take the adjustable payment and of course, look to be able to pay a little bit less overall in monthly payments and cash flow if rates go down, knowing that there is the risk of payments going up if the opposite occurred. Overall, here's my advice. In any rate environment, particularly in Canada, you need to have a good grasp on a few things. Number one, what's your budget and do you have any flexibility? Number two, do you have the ability to see your payments go up or down in the marketplace? Number three, are you the type of person that would look to make changes? Like, do you want flexibility in your life? Like we talked about, prepayment penalties. Would you be comfortable with market fluctuations? Number four, have you considered the possibility, and this is a bonus one, of even a hybrid option? There's mortgage products out there that you could put part in a fixed and part in a variable, which could actually not only save you money, but you put you in a position where you can actually sleep at night knowing that you're diversified in your mortgage portfolio. So in the end, people usually end up asking me, Alex, cut to the chase, should I take a fixed rate or should I take a variable rate? Listen, I take a variable rate on almost all my products, and I typically always do because I'm okay with the market conditions going up or down. Historically speaking, I understand what's happened in the marketplace, and I do believe that over an extended period of time, I will win, if not for the flexibility around the prepayment penalties, but also for the fact that the marketplace might continue to see those dips. I'm also comfortable in my budget knowing that the monthly payments, if they go up, aren't going to cause me to lose my home unless it was absolutely very dramatic and something that we haven't seen since the early 1980s. Please don't call me boomer dads. You can comment below if you want to. I'd love to know in the comments below today, are you taking a variable rate or a fixed rate? What are you doing? Are you taking a variable pug or a fixed pug?